Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The immediate pattern here since September 2024 had been, and still is I suppose, after a fashion, the breach and now seemingly repaired dark blue September-December 2024 bear channel, currently 1711 to 2004. This pattern achieved its primary downside target mid-January and its secondary harder to reach target about a week after the primary target. Interesting, the move down to the secondary target and back up again formed another new pattern, one which I will discuss shortly. However, before that, I'd like to highlight again another larger long-term pattern, that is the bright green breached but possibly moving to be repaired November 23 to September 24 bearish Andrews pitchfork. This pitchfork, as I said, had been breached but has been undergoing surgery for the last 3 weeks to be repaired as it straddled the breached bright green upper time, currently at 19 even, over these last 3 weeks. However, I've been considering finessing this over the last few weeks, and today I decided to draw on my daily chart the bright red, shallower, bearish shift pitchfork for this, as well as leaving the original bright green bearish Andrews pitchfork here as well. It is something I don't normally like doing, but I think it warrants it this time. We're on this one, between the bright red upper time overhead, currently at 21 even, and the bright red middle time below, currently at 17 3/4. I have another pattern which I would like to discuss, and maybe another to think about. The pattern discussed is the bright pink late September 24 to mid-January 25 bearish Andrews pitchfork, which I drew 4 weeks ago to try and help make some sense of the recent moves. We are today still in between the middle time below, currently at 1770, and the upper time above, currently at 20 1/4. Elsewhere, during the last 2 weeks, we have dropped below the green short medium moving average, currently at 1943, which had been reinforcing the bright green upper time, as both of these are now separating. And we are today testing on the downside below the February 2021 high 1894, and a little further down below the first pair of interesting 50% Fibonacci lines that we have together. The first is the near April 20 to November 23 move at 1859, which we are hovering over right now. Then the very interesting 21st century 50% absolute Fibonacci line at 1809. Okay, so it's time to repeat part of my commentary from 4 weeks ago, and ever since that time as well, when I said, and I quote, "So in an effort to get a handle on what further technicals were operating here, I went back to my annual commentary last week and looked at the monthly charts there, and I saw that the bright green Andrews pitchfork, despite the breached topside, is still the dominating pattern, along with a double top and Adam and Eve type that had been constructed throughout 2023, and which had already reached the primary target 1880, leaving live a still as yet unfulfilled, harder to reach secondary target down at 1630. This longer term pattern is the one I choose to watch, and I'll see how it develops." End of quote. I will still maintain that point of view. Ice syrup, white sugar in London. There continues to be 3 features to bear in mind here on this daily chart. The first is the obvious purple late September to date descending expanding wedge pattern. This pattern has more than the requisite 5 touches and was severely tested on the top side over late February through into the start of March, when prices dipped back down within the pattern. However, 4 weeks ago the market pushed up over the purple upper trend line, currently at 524.90, and even gapped higher 3 weeks ago, threatening and briefly breaching the high made in late February at the February 2017 high at 565 even. However, the market has not stabilized over this February 2017 high, though it has seemingly stabilized over the purple upper trend line. The second is the January 24 to date downtrend, currently at 561 even, and that's highlighted in bright red on my daily chart. It had effectively capped earlier rises when it was at a lower level, most recently in late February, but 3 weeks ago it was breached enough that I chose to realign it to include the highs of 3 weeks ago. The third is the flatlining gold long moving average, currently at 540.60. This had previously helped cap prices, but we saw a gapping push up over it 3 weeks ago And, as I said 3 weeks ago about this gold long moving average, and I quote, unless the market turns down and rapidly, then I'll pare down its importance, end of quote. Well, we've seen prices turn down, but the market is seemingly utilizing this flatlining long moving average as a sort of attractor and rotating around it. I'll keep it highlighted, but I'm not sure how good it is. Okay, so I'd now like to run through some newer features I discussed 2 weeks ago and a potential pattern I introduced 3 weeks ago. Unfortunately, some of these patterns are on the verge of being retired already. The first feature was to lay out some potentials for a move up and out of the purple descending wedge pattern. I said 3 weeks ago that, and I quote, these may be a bit premature, but I'd rather lay these out now than later, end of quote. Thus, a primary topside target X is in the 650.10 area, with a secondary harder to reach target X1 up in the 673.80 area. This week they are once again quite a way away, and I've had thoughts over the last few weeks about retiring them. After today I will. Next is to view the whole late January 2-day action as a possible bullish halfway hesitation. Now I added 3 weeks ago, and I quote, if this becomes the case, and we will have to see how prices perform over the February 2017 high, then we can start viewing the primary target X2 up in the 605 even area, end of quote. Well, last week I was on the verge of retiring this idea completely. After today I will retire it. I'd also drawn a pink bearish late September 24 to late February 25 Andrews pitchfork. However, I have not been happy with this pattern, and today I finessed it into a shallower bearish shift pitchfork. We're in between the overhead upper time, currently at 553.90, and the middle time below, currently at 498.10. Okay, so last week this left us with potential choice of two new pattern possibilities. A possible mid-January to date bullish halfway hesitation, or, and it is an or a possible double top for the same move. Neither have come out well of this week, so I'd like you to consider some other ideas. A possible late February to date ascending triangle, or late February to date ascending wedge pattern. Now I have not marked these on my daily chart as yet, but I will be considering them for next time. Sugar white premium spread. A bullish engulfing pattern last week after the previous session's hammer pattern, a hammer pattern that's usually seen as bullish. Below we still have the gold 1 year moving average, currently 108.25, though this is now heading lower. We have seen over recent weeks a reluctance to push below this gold 1 year moving average, as well as over the overhead significant combination of 50% Fibonacci lines of the July 2019 to September 22 move at 128.75 and the August 2021 to September 22 move up at 131.25, plus the June 2020 high at 134.25. Overall, we can start to see the action over recent weeks as a halt in the break up and out of what was originally a descending wedge pattern that developed into a big bear channel from April 24 to the end of January 25. We have now been hesitating for 6 weeks between 111.75 and 127 even on the wide. Is this enough to start talking about a possible bullish halfway hesitation from the start of the year, or else a topping action? Well, at the moment I'd still favour the idea of a possible bullish halfway hesitation, but I can start now to see the merits of a topping action. Hence I will retire after today from the original large descending wedge pattern seen throughout 2024, which is still on my daily chart, of a primary target X up at 137.5, which is above the immediate overhead resistances, and a secondary harder to reach target X1 up at 154.5 area. So have these targets been achievable? Well, yes, but there was a very large question mark hovering over all of this due to the overhead combination of the previously mentioned 50% Fibonacci lines, plus the June 2020 high and a congestion area we have overhead between 128.75 all the way up to 153 even, which has made the idea of target X and target X1 originally pretty hard, but now no longer viable. As for today, well, as I said last week and also now for 4 weeks, and I quote, The market has not taken the bullish incentive by the horns. Sorry for the mixed metaphor there. We've not pushed just that far high enough as yet. End of quote. I also pointed out 4 weeks ago, and I quote, apart from this gold long moving average, we really don't have that much below until we start approaching the 85 even zone. Nothing seems to have changed on this idea.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.